I actually bought Chipotle the day it went public. And I bought it primarily because there were lines out the door in New York City to buy. And I said to myself, look, there's 100 places to get lunch on
Yeah,
every block in New York.
yeah.
And so people only wait in line if they think something is really superior. And so I did some very superficial analysis of the business, and I thought it looked attractive. So I bought it. Then over a period of years, I made it my largest ever position. The initial
Hmm.
purchase was quite small, but I got shaken out of it during the financial crisis.
Hmm.
So it would have been worth many millions of dollars, the position,
Yeah.
if I had not sold it. And I sold it because I said to myself, maybe I don't need to own it right now. And
Hmm.
I very vividly remember. So this is a lesson for me, which is to um, focus on individual company fundamentals and don't
Yeah.
not to let macro and overall market movements adjust an investment strategy. Look, maybe bad things are going to happen and there'll be no recovery in the future, but that's what we say every time bad things happen. So
Hmm.
my thinking is that those businesses should continue to outperform or can continue to outperform over a longer recovery period, even if um, the macro becomes exceptionally difficult. Now, selling after everything goes down because you feel scared, that definitely doesn't work.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is John Zolidis, president and founder of Zolidis Capital. Over the last 25 years, John has built a reputation as one of the most insightful analysts covering retail and restaurant companies, combining rigorous boots-on-the-ground research with a keen eye for the fundamental drivers of consumer business success. John, how are you? So nice to see you.
Thanks so much for having me on the show.
Well, you and I got to see each other many times, mostly at Guy Spears Value X. We both decided to participate in the snowshoeing expedition and spoke more. And I've been really looking forward to having you on the show. I got to see the depth and the quality of research that you do, given the presentations I heard at Value X, and I was very curious about the kind of work that you do. But before I get there, I want to ask you about the early days, if you allow me. And I'm always curious about my guests and their childhood and upbringing and how you think that time shaped you.
Okay, well, I mean, that's quite an open-ended question. Um, I mean, I grew up in a small town or a reasonably small town in Wisconsin. Um, and I was far from financial centers, and I didn't really see people going off to work in business or investment banks or that sort of thing when I was growing up. So there wasn't really a interest in doing any of those sorts of things. I didn't buy my first stock at 15 years old or anything like that that you hear from professional investors occasionally. I had absolutely zero interest in that sort of thing. Um, I was lucky, I think, in two regards. One is um, this might sound a bit odd, but I was able to spend a lot of time alone in nature.
Hmm.
And I've spoken to a few other people who actually perceive that about me without me telling them. And I
Mm.
think that uh, if you are in nature, it actually allows your mind to be a lot more flexible in observation, and a little bit freer in thinking because you're not surrounded by objects that have a defined purpose or use. And so I think it just creates a little bit more space for creativity. But I'm going to leave that there because I'm not a psychologist. The second piece that where I was lucky is that I was surrounded by a group of exceptionally intelligent friends. And so rather than what you might think of as a stereotypical small town upbringing, I had friends who wanted to talk about quantum physics and the Egyptian Book of the Dead and Tibetan Buddhism and all sorts of obscure intellectual topics, which was a method of escapism for the lack of other things to do in the town. So I'll answer your question that way.
Well, I love the sound of it. I might be one of the few people that have read the Book of the Dead and the Egyptian one that you mentioned. And I was fascinated with Egypt when I was a kid. I knew the dynasties, I knew so much about it, and I was just fascinated that such an elaborate world existed so long ago. And that book is really interesting because to think that it was written at that time, thousands of years ago, but it's so relevant and feels like it could have been written 5 minutes ago. I want to emphasize the nature part. I had quite a few guests on the show that talk about that peace and quiet, and I spent a lot of time in nature growing up as a kid, walking around with my dog. But in the last few years, I really cherished those moments where I can be at peace somewhere in a quiet place, just walking around. I feel like it's a place where I can hear my thoughts, which is not that easy or wasn't that easy when I was living in New York. But I'm sure we'll come back to that to it. You are working on a book, and I have a million other questions, but I want to tease the book a little bit. You were kind enough to share with me a couple of chapters, but I want to bring up one story, if you let me. You talk about reaching a 1 million mile flown milestone, but you add, while sitting in an economy seat, and you add more on a flight from Paris to New York, and you're hinting a couple of things. You left New York, you left your Wall Street career, you started a business on your own, and you moved to Paris, far away from Wall Street. There's so much to unpack. And the fact that you collected a million miles, there's a story there too. And I believe you added another million to that too since.
Okay, well, I have not added yet another million. 1 million is already quite a lot. It took 33 years to achieve that on the same airline. Um, so yeah, I thought that was an interesting metaphor to for investing and for a career, right? So it's not a investing isn't a get rich quick experience. It's a
Mm-hmm.
long slog, and being stuck in economy for a million miles um, could get you there if you have the right process. So that was
Right.
part of the thinking behind using that as a prologue. The second part is that there really is a ton of travel, and there's a lot of interesting things that you can see in different places. And as I was writing the book, almost all of the episodes occur in different cities or in multiple cities or during interesting international interludes. So there's a theme of travel. It's almost a investment travelogue, if you will. So that's the working prologue at the moment, if you will.
When I'm looking forward to reading it, and it's a fascinating journey of both, the investment career, but also you seeing the world, meeting so many managements in different places, and then moving your life from one side of the Atlantic to the other. And we'll come back to it later on. I love to explore it more. I want to ask you about the early days past the childhood. There was a moment when you decided to study philosophy, and then you switched to finance. And I feel like there's a lot of philosophy in finance. I mean, even listening to Warren and Charlie over the years, I feel like we're talking more about philosophy than finance. But tell me about your experience, and how do you think that background maybe helped you in becoming a better investor?
So, as I mentioned earlier, I didn't have role models working in finance. I wasn't really interested in investing. I pretty much went to college and decided to not read a single newspaper for 4 years, and I was quite proud of being completely cut off from whatever was happening in the day-to-day world, what have you. I was interested in studying philosophy with the objective that I wanted to do an activity that was robust and difficult, but that would provide me with a skill set or perspective to enjoy life better.
Mm-hmm.
So I wasn't trying to get to a nihilistic conclusion. I was kind of starting with the nihilistic assumption and trying to reverse engineer a more meaningful existence, if you will. But what I really liked was the mechanization of going through complex arguments and thought and trying to manipulate that in my head to try to find errors in the reasoning or um, approaches, and then to propose new or interesting variants that could find solutions for problems that other philosophers had proposed. So it was a really kind of inside the head sort of activity, if you will. Um, so I did philosophy undergrad. I took some time off. I lived in the Czech Republic. I then worked briefly for my father's aerospace engineering firm, um, um, Sundstrand Aerospace, which later became part of United Technologies, and as an engineering intern. And then I moved to New York to do a PhD in philosophy, and I started my PhD. And in the PhD, I studied philosophy of language and symbolic logic. And in philosophy of language, you're trying to answer questions about the relationship between our thoughts and understanding. What is understanding? Um, Language and the world. If you think about philosophy, you define the area of philosophy by the questions it's trying to answer. So existentialism is what is the meaning of being and why is there something rather than nothing? Metaphysics is what is. Epistemology is what is the nature of knowledge. And philosophy of language or philosophy of mind is, what is understanding? What is meaning? How do we communicate to each other using language? And the arguments and the debate at the graduate level involves memorizing all of the different steps over a period of 200 years to arrive at the present state of the questioning and the debate about those topics, and then trying to contribute your own viewpoint. But before you contribute your own viewpoint, you need to understand all of the people who've come before you and their arguments and how they stand on each other's shoulders. It's pretty complex. Symbolic logic is taking those same kinds of arguments, converting them into symbols, and then doing a process called a deduction where you try to determine if the argument is logically valid or not. Um, it's somewhat like math, but without numbers.
Hmm.
I found it like really interesting, um, but it's also very challenging. It's after a few hours of doing that, or even and like you're mentally spent. You can't really do anything else. It's also extremely difficult to carry on a normal conversation after you have spent a lot of time breaking down sentences into their component parts and analyzing them for logical coherence. Because the way that normal people just speak is quite loose and that's perfectly fine, but it doesn't fit into this mechanism that you're training yourself
Hmm.
uh, to proceed with. So, to answer your question, when you come to uh, finance, it is just not nearly as robust of a difficult topic. So, in the book that I talk about, I mentioned went to an interview where I had absolutely no financial background whatsoever, and the director of research asks me if he gives me a balance sheet for 2 consecutive years, can I calculate the cash flow? And I had no idea how. But I was so thinking to myself, is it difficult? Um, and I think, I didn't say that. Instead, I said that I felt that, with proper training and a little time that I could figure it out. He was not at all impressed by this response, and he kind of sent me packing. But I do think that the rigor of
Hmm.
thinking through philosophical arguments is very applicable to evaluating corporate strategy and trying to understand the investment world. In addition to that, equities contain a lot of qualitative components to them. So if you bring only a quantitative, which I'm describing here in this philosophical sense, analysis or approach, you're going to miss like why do people pay more or less for this particular equity, and why does this particular company do well? But within philosophy, there's also a way of addressing that. So my favorite philosopher is Wittgenstein. And so Wittgenstein talks about the limits of language and where it can't go further. And these are these kind of soft things that also happen in equities. So you need to be able to think
Hmm.
in both ways. You need to be able to do the quantitative analysis, and you need to
Hmm.
also understand the qualitative components that people bring. So I think my background, my educational background, whereas there was not a bunch of finance and business involved, was very applicable to what we're doing as professional investors.
I love that story because I feel like education as such could teach us to think much more than collect the right tools right away that you might need or not need. And I can clearly remember how a lot of my classes courses were about memorizing, and then at some point quite a few were giving me a chance to think and question. And I remember much more the latter, and I feel like they helped me in life. And I took philosophy at some point, not as deep and as much as you have, clearly. But I think those moments where I was asked to think and I knew there's not always one answer, I felt that I'm actually growing as a human, as a thinker. And I like that story that, you didn't know how to read the balance sheet, but you knew you can learn. And it's so empowering because there are things we're going to continue to learn for our lifetime. You can, well, I mean, maybe you can, but I don't think it's necessary to have all the tools at 21 or 22 and then never learn anything new. It's quite the opposite. You have to be open to learning new things. We're learning AI as we go. I'm talking to people about how they use it in their workflow. We continue to learn, right? So the ability to think and challenge and question, I think it's hugely valuable. I don't want to miss that point that you dropped in there, that you were not reading the news for 4 years. I want to highlight that because I wrote a couple of articles about information diet. There's just so much news coming through, and headlines. And I like Nick Sleep's idea of the shelf life of a piece of information. And I actually heard him speak in a room how he said that news only means that it's new. It doesn't mean that it's relevant or valuable. And it's such a powerful revelation. Just because it's new, it doesn't mean I have to care about it or know about it. But what will be relevant 3, 5, 10 years from now, especially when you're evaluating a business? It's a whole different mindset than thinking month to month, day to day, quarter to quarter. I want to ask you about your firm, Zolidis. How did the name come about? Tell me about the story. And I know it's a Latin expression, a biblical passage, and there's more to it. I'm curious to learn more about it. I feel that the names of businesses are very meaningful, and I think yours has a story.
Okay, thanks. So I wanted a classical reference,
Mm-hmm.
and I looked around for various ancient Greek things that I could use. And I mean, you wouldn't believe it, but just the most obscure thing that you can think of has already been taken as a name. I was really excited because I discovered there was the name for the silver mine where the Athenians got their silver that they used to
Mm-hmm.
fund the fleet of triremes to defeat the Persian army. I was like, that's a great name, already taken. Um, otherwise, other ancient Greek things, great stories, but unpronounceable. So, kind of
Right.
gave up on that. So, quo vadis in Latin means where are you going,
Mm-hmm.
which is perfectly fine as a investment idea. But there's
Mm-hmm.
also a biblical parable, which is probably familiar to most Catholics or many Catholics. I'm not Catholic, but the story is that Saint Peter is leaving Rome during a period where the Christians are being persecuted.
Mm-hmm.
And of course, what happens when he's leaving Rome? He encounters the risen Jesus. And so he asks Jesus, Quo vadis, where are you going? And Jesus says, I'm going to Rome to be crucified again. And based
Mm-hmm.
on this interaction, St. Peter turns around and goes back to Rome where he is crucified upside down. So, what I like about this is it's a story of conviction,
Mm-hmm.
but it's also a cautionary tale about where your conviction can land you. So, when we think of things from an investing standpoint, these are both positives and dangers that we encounter.
I love so much about this story. I work with families. I manage money for families, and usually it's multi-generational family fortunes. And one of the first questions that come up, especially with new clients or with the next generation, is where are we going? Like, what's the direction of it? And a long-term vision. And usually it's a 100-year vision. I actually asked Charlie and Warren in Omaha 3 years ago about their 100-year vision, because you might have an incredible business or incredible family fortune, but it's very important to know where you're going. And I love that perspective and the conviction. I feel like in investing, sometimes our convictions get tested. So having the conviction and sticking to it, it's very important. But I love that story. I'll mention real quick, and I mentioned it to you, there's a book written by a Polish Nobel Prize winner over 100 years ago with the same name. And it's the story of early Christians in Rome under Nero. And a beautiful read, a beautiful book. It was made into a movie, but your story made me think of that book as well. I want to ask you about the big picture investment philosophy behind the work that you do. How do you think about it?
So, so I have kind of three activities as from a professional standpoint. So I have a tiny asset management business where I'm managing money for individual investors. I have a research business where I provide um, targeted long and short investment ideas within my sector of specialization, which is retail and restaurants, to professional investors, hedge funds, mutual funds, pension funds. And then the third activity I have is providing ideas through something which is called alpha capture platforms. And each one of them requires a slightly different approach. But if we
Mm-hmm.
start with the asset management and how I invest my own capital and for that of my clients, it's very long term. I look for high quality businesses with strong operating margins, very good cash flows, and most importantly, the ability to reinvest excess capital back in their own business at a high rate of return.
Mm-hmm.
And then I try to buy those stocks opportunistically and
Mm-hmm.
then hold them as long as the fundamental thesis about the strength of the business is sustained. So
Mm-hmm.
that's what I'm doing. So it's very low turnover. It's very cash flow oriented. It has a value overlay in terms of when I go into the stocks, but I don't concern myself too much with the valuation. Once I've established in a position, I focus more on the fundamental growth characteristics of the business so they can continue to deliver returns in excess of weighted average cost of capital over time.
What's your typical research workflow? I'm very curious about it. So there are many ideas to look at. I know that you know your universe very well. I'm under the impression that you know every single name in your space that you wanted to know or wanted to get to know. But how does it work from the idea generation to an investment decision? That process, how does it look for you?
Okay, well, when I'm talking about the space where I'm a sector specialist and an expert, so
Mm-hmm.
retail or restaurants, I solve for which companies can be divided into component segments, which I call unit economics.
Mm-hmm.
I didn't coin that term, but I look for businesses that can be analyzed from this perspective. Then I solve for the metrics of that particular business and I compare it to a peer group of other companies in which I could invest. And so I've done this, I've probably analyzed 100 different concepts. So I have a large reservoir of past businesses that I've looked at within which I can place a new concept. And so
Mm-hmm.
from that, I judge the quality of the business. The second step is to look at the direction of the fundamentals within the unit cohorts. So I'm trying to solve for, is this business getting incrementally more profitable or incrementally less profitable? Are the most recently deployed dollars or euros or whatever it is into the business generating a higher return or a lower return?
Mm-hmm.
And so I want to own businesses that are generating incrementally higher returns on the most recently deployed capital. Um, then I also may look for a disconnect between how the street is valuing the business and the fundamental ROIC characteristics of a particular company. So I'll give you an example. So one of my number one best recommendation for my professional clients for the last 10 years has been Sprouts Farmers Market.
Mm-hmm.
So it's a grocery store, but it's also a specialty food retailer.
Mm-hmm.
And 7, 8 years ago, the street really hated the stock. It traded at a very low multiple, maybe 5, 6 times EBITDA, double-digit free cash flow yield, and it was viewed as a undifferentiated small company competing with Walmart and other conventional grocery retailers that couldn't really grow.
Mm-hmm.
But when I analyzed it, and I'm not a grocery specific analyst, I calculated that, hey, this is a very profitable cash flow generating business. The stores, the unit level returns at the stores were very high and the cash flow is high. Now, recently I just did in another analysis, another look at it, and I said, well, why is this? And it's because they have 14 times inventory turns. Now, maybe that
Mm-hmm.
doesn't mean anything to some of our listeners, but an average retailer would do like 4 times.
Mm-hmm.
And the reason that an elevated inventory turn number is advantageous is it means much lower levels of working capital.
Mm.
So with a lower margin business and very fast inventory turns, you can still generate bucket loads of cash.
Right.
So that's the metric that we use to evaluate return on invested capital. How much cash does this business generate at the unit level? And then you
Mm.
look at what is the company doing with this capital? And in this case, they were spending all of it on share repurchase,
Mm.
aside from whatever they needed to run the business. So you had, and they did do some debt payment. They had some debt 7 years ago, but you were getting great returns at the unit level, big dividend in terms of stock, trading at a low multiple, I think with a double-digit short interest. Um, and so I think that I was so this is just being really inappropriately valued. Now, then they brought in a new manager, and it happened to be someone that I knew because he was previously in charge of Walmart's grocery business. And I had a very high opinion of Jack, and I thought he could do a great job. And still, the street had zero interest in it. And he started, he uh, proceeded to build a new set of smaller distribution centers to improve the quality of the produce. Um, then came COVID, which
Mm-hmm.
amplified the business, but still the street didn't really recognize what was going on with it until more recently. And then now it's become a very hot stock. And I think it trades at over 20 times EV EBITDA. So it's gone from 5, 6 times EBITDA to 20 times. They've bought
Mm-hmm.
back a third of the shares outstanding in that period. The stock's up, I don't know, 500, 600%, something like that. So that's an example of a company within my specialization, in this case retail, where the unit level economics led me to a conclusion about the business, which was at odds with the prevailing understanding. And I believe because the other analysts, or some other analysts, let's say, were coming with an industry framework rather than a unit level economic framework. And that was leading them, or some of them, to not appreciate the qualities of the business.
There's so much in this story, and I'll just mention what's obvious to the audience, I think, is that any stock we mention here, it's not a recommendation. Do your own research. But what you mentioned is fascinating because you have a business that you appreciated and you saw the quality behind it. And I have a list of questions when I build an investment case. And the first one is just tell me what it is if I've never heard of the business. And then the second question I ask, why now? I'm trying to answer, why are we talking about it now? Because there's so many stocks that might have been public, for 10, 20, and sometimes, 80 years or 100 years. Why are we talking about it now? And I'm curious about that trigger that you hinted that there was a moment that you saw quality, but there was some sort of misunderstanding or the market was not appreciating what this business stands for. What's that trigger? Is it a price? Is it a valuation? Is it a perception? How do you find that moment where you feel like the market, the investors are missing the bigger picture here?
I think it's unique to each situation. I think
Uh-huh.
that's how I'd answer that. I'm trying to think of a second example, in addition to Sprouts to talk about. I mean, I have a name that's um, working quite well right now, which is called National Vision, and it's a retailer of eyeglasses. And I spoke about this a year ago at the Value X Val conference, and their uh, business is quite defensive in that people need glasses. It's a medical necessity have if you have vision that needs to be corrected. They don't last forever. Your prescription changes, you break them, you lose them, they need to be replaced. Um, And historically, the business focused on lower income cash paying customers
Hmm.
by having a very strong value proposition that they were offering. And instead, they recognized that over time that they'd actually picked up a higher income cohort as well that came in with insurance and the ability to have their insurance pay for the glasses. But they recognize that, hey, we've never actually marketed to this customer. We're not optimizing this customer. We don't
Hmm.
have an assortment that fully utilizes the customer's allocated annual benefit. So we're essentially leaving money on the table because our price points are too low
Hmm.
and the customer can't fully take advantage of the insurance that they paid for. So they need it. So they've now distorted their assortment to include a component specifically designed for an insurance customer to fully utilize this benefit. And guess what? Your average price for the transaction has increased. And your cost to deliver that product to each customer is exactly the same. So when
Hmm.
you drive higher average transaction values through a box that has a consistent expense, you get margin expansion and everything is wonderful. So the stock's up 100% year to date as they've executed this transformation. And so I think in answering your question, here there was a strategy change that wasn't you had to be paying attention to the company to kind of recognize how that this happened, and then to think through what the implication would be for earnings and margins.
Again, do your own research, whoever is listening. But uh, you saw an inflection point, a change in the dynamic in the business that got you more interested in it. And I can see how that can really change the direction of the business. I want to come back for a second to the concept. You know, we talk about return on capital. You talk about return on incremental invested capital. And I find the concept fascinating because a lot of people, when they run screens, they look for high returns. But a lot of the data is backward looking. We have businesses, I'm sure you're familiar with, that for a long period of time could achieve very high returns on capital. And they're having a hard time finding the same kind of opportunity going forward.
Yeah.
The cash flow is coming and they're under pressure to put that money to work. And obviously over time, maybe they'll pay a dividend or do a buyback. But the first intention is maybe we'll put it back to into the business. How do you go about finding out what's that incremental capital return that you're getting that the company is looking for? How do you go about it? Is there a formula, or how do you find out what it is?
So the answer is really tedious modeling approach.
So it's easy.
I mean, it's not hard, like difficult. It's hard,
Yeah.
like tedious. So, and
Uh-huh.
I guess there's a process component, which you need some experience, I guess, to do. So what I try to do is solve for a company's most recently opened stores. Like how
Mm.
is that cohort doing? And so it goes beyond looking at the sales productivity.
Yeah.
So I think new store productivity is a metric that restaurant or retail analysts look at. Um, by the way, this applies to like fitness gyms, uh, car washes, movie theaters. I mean, anything where you can identify a specific amount of capital in some and measure the performance of that piece. So, in addition to getting the revenue piece, which is relatively straightforward, I try to estimate the margin contribution of the
Mm-hmm.
most recently opened stores. And then I also look at the investment side. So we calculate how much CapEx per new unit is being brought to bear. If it's a leased business, I estimate using the 10K the leases at the rent expense per new unit, which we capitalize. And we're getting a little bit into the weeds here, But
Mm-hmm.
that's the answer to your question is you need to go through this exercise to arrive at an estimate for what the return is at these most recently opened stores. Now, in addition to that, you need a history. You have to
Yeah.
be able to compare that to how it's been going over the last 2, 3, 4 years, whatever it is, so that you can
Mm-hmm.
identify if there's a trend. And
Mm-hmm.
so that is the answer. There, a great example is Chipotle. So when
Mm-hmm.
Chipotle went public and they started opening new stores, um, each year for about 5 years in a row, the new stores did 10% more volume, roughly, than the previous year. Now, why was this the
Right.
case? It was the case because the brand, the Chipotle brand, was
Mm-hmm.
growing faster than the store base. So that when they opened up in new markets, the consumers were already waiting there wanting to eat at Chipotle before the store even
Mm-hmm.
opened. Now,
Mm-hmm.
think about this from a modeling perspective. If your new stores are sequentially opening at, I don't know, 5 to 10% higher revenues each year,
Yeah.
the incremental flow through is very powerful. Now, in addition to that, there's a practical element here from a stock selection perspective, which is that um, analysts typically never forecast changes in new store productivity on a going forward basis, which this
Mm-hmm.
speaks back to your question about screening for high ROIC, but missing incremental
Mm-hmm.
invested capital. So what this means is that estimates are chronically too low if you can find something like this. So what makes a stock have valuation expansion? Consistent upside and upward revision to forecasts. So by zeroing in on the most recently deployed capital or most recently opened stores, you can identify scenarios where estimates are chronically too low.
Mm-hmm.
And this creates a very virtuous stock investment scenario if it's combined with a high return on invested capital business to begin with. The opposite is also true. So if you've opened up too many stores and
Yeah.
the store productivity starts to decline, you know that's typically a sign that perhaps the business has become saturated, or if it's a fashion company, the look has gotten old, and you're looking at margin contraction going forward, which is usually accompanied by valuation and multiple contraction.
I think it's a brilliant way of really analyzing a business, especially the one that's opening new locations, whether it's restaurants or stores. In an ideal situation, you would like a moment or a phenomenon where, because you added a new store, the original store performs better. For one reason, I mean, there might be many, but just the purchasing power, for example, right? Because you added 100 more stores, the whole company has even more purchasing power when they go to suppliers. So even the very first store that you opened 10 years ago will have some sort of a benefit because the cost could be a couple of cents less per unit to put something on the shelf in the store. Just to think about it, that you could actually allow that original store to perform even better, even though it's not in a completely fresh, new, virgin territory. Just something that somebody pointed out to me that I find fascinating, that the whole ecosystem gets better and better. That's an ideal thing. And obviously, as you pointed out, at some point you might have too much in too many places, and the whole thing just performs worse and worse and worse. And unless they catch it, it might be really detrimental to the business. John, I want to ask you about some macroeconomic indicators that you look at. We're talking about consumer companies, and there's no shortage of opinions about how the consumer is doing, even this minute today. 2 weeks ago it's weaker, now it's not as weak as we thought, and then people change their minds. There's firm lending, no lending, soft lending, hard lending. There's a whole vocabulary. How do you look at the indicators that help you gauge how the consumer is actually doing and how those companies could perform given the environment we might be going through at any point in time?
Okay, well, great question. So the number one thing I always look at is employment.
Mm-hmm.
So I think the period that we just went through, where everyone was panicking about tariffs, is
Yeah.
a good case in point. So there were very disruptive headlines. The market dropped about 12%, 15% over 2-3 week period. There were reports that
Hmm.
consumers were pausing or feeling uncertain because of the headlines. And that led some people to believe that the consumer was, closing up their wallet and we were going
Hmm.
into a recession immediately and no one was going to buy anything ever again. Um, Now, consumers can be disrupted by headlines, but
Yeah.
typically they just absorb them after a period of time.
Hmm.
The thing they can't absorb is losing their income.
Right.
So that's the number one thing that I look at is incomes. Do they still have incomes? If they have incomes, they're going to spend. Now, there's the psychographic pieces like the headlines we just talked about, and then there's the expense side of the equation. So during the post-COVID inflationary period, consumers remained employed, but their ability to buy things was compromised, particularly by inflation in food and necessities.
Hmm. Hmm.
So as a result, what you saw was less spending on discretionary items and trade down within categories. And you also saw some things like trading down from what we call food away from home, so eating in restaurants, to food at home, eating at home.
Hmm.
Um, So as we look forward for the potential impacts of the tariffs, which hasn't yet flown into the stores, I was just speaking with Walmart yesterday, and they said that the year-over-year change in prices is going to be first apparent to the customers with the back to school period, which starts mid to late July. Um, that what will happen when the consumers see these higher price points? Now, interestingly here, the food category, the necessity category is much less impacted because
Hmm.
that tends to be domestically produced or produced either in Canada or Mexico under the exemption. It's the discretionary items that are coming from the Far East that are more likely to be affected by tariffs. So I think what we'll see is trade down and fewer purchases, but you're not going to see the consumer stop spending. They're just will buy fewer units.
Right.
So if employers um, become concerned and stop hiring new consumers, that's a problem. If capital projects get canceled because of headlines, that's a problem. But I think so far what we've seen is that the momentum and power of the overall US economy is much greater than something that can be disrupted by some headlines. Now that can change, but if you think about jobs, people getting hired on a month-to-month basis, a lot of those projects were put in place months or years ago. They're not going to be
Hmm.
easily canceled. And companies aren't going to stop investing in artificial intelligence
Yeah.
because it's going to cost more to import items from China. So the economy is still on pretty strong footing despite all this disruption that's kind of repeated in the financial media. And so that's my focus. I just focus on employment first, and then these other factors kind of on a secondary basis.
No, that's very helpful and very telling. Employment, once you lose a job, you can't spend. But just watching and how it has an impact, and the point that you made about headlines, headlines have a psychological impact on us, sometimes more, sometimes less. But I did notice, and I don't know how long lasting it was, that when the market was down, even my clients that are more than comfortable would say, "Oh, we'll postpone certain purchases." And I would tell them, "You can definitely afford that purchase." But it's almost like a vote. I feel like things are not well, so I'm not going to spend money. But that's what could actually lead to a weaker spend and weaker metrics, right? So it's connected. But I always wonder how short-lived it is
So I
because
hear that
it goes
argument.
away.
Look, it's not it's not false what you're saying,
Mm.
but
Sure.
again, this is maybe having grown up in a small town in the Midwest. my feeling is that the Wall Street focus on what's happening with the market is vastly, vastly greater than what the average person spends thinking
Of
about it.
course.
They don't open the paper and check their 401k before they decide what they're doing this week. I do think, shocks can influence short-term changes in spending behavior. And yes, maybe a very wealthy person might decide not to buy a third or fourth home because because the stock market went down 10%. But I think that the average family is quite insulated from these financial movements. As an example, I remember during the financial crisis
Hmm.
in 2008, I think when the first TARP got voted down, I think the stock market dropped like 700 points. Everyone in our office was just despondent. We were like, we were thinking we are going to be like foraging in the woods for berries soon. And then, it's just terrible. I had all of my money invested in the market, my business is in the market, everything I'm doing is in the market. And then I
Yeah.
went out on the street and was like walking home, and everyone was walking around and like things are normal.
Yeah.
And I realized like how I was so myopically focused on what's happening in the market,
Hmm.
and other people just are completely insulated psychologically. They just don't care. It's not affecting them. So I think the Wall Street framework does tend to make us overstate the impact of the market on how things actually flow through the economy.
I think it's very true, and I have my own memories of the financial crisis. How we would have one of the worst days, and I would walk out from the office, and New York seemed just fine. There was a delay, and some stores closed in the coming months, but there was a delay. I do remember going on a ski trip that winter, and I think I was one of two people out of 20 some people that joined me on this trip that had a job, because everybody lost their jobs. and, and everybody was still in a good mood, but I think it took them longer to get new jobs at that time. So we have this, myopic, as you said, perception of how the world works, especially in New York, in a high rise, sitting in an office. But there are those moments when the stock market is not the economy, and the economy is not the stock market, and the headlines only go that far. And March of 2009 was the best time to buy stocks.
Sure.
But I remember the fear in people's eyes, and people that were much more experienced than I was at the time. And I thought that the world really ended. Same thing happened in March of 2020. I took a lot of calls from friends in the business, and there was very real fear, and that this is the end of equities for a while. I know people that liquidated their holdings in March of 2020 and continue to regret it for years to come.
Well, just to echo that, one of my biggest lessons, in which I mentioned in the book, I think I mentioned this in the book, was, well, so I actually bought Chipotle the day it went public. Um, and I bought it primarily because there were lines out the door in New York City to buy. And I said to myself, look, there's 100 places to get lunch on
Yeah,
every block in New York.
yeah,
And so people only wait in line if they think something is really superior. And so I did some very superficial analysis of the business, and I thought it looked attractive. So I bought it. Um, then over a period of years, I made it my largest ever position. The initial
hmm
purchase was quite small, but I got shaken out of it during the financial crisis.
hmm
So um, it would have been worth many millions of dollars, the position,
yeah.
if I had not sold it. And I sold it because I said to myself, maybe I don't need to own it right now. And
hmm
I very vividly remember. So this is a lesson for me, which is to um, focus on individual company fundamentals and don't
Yeah,
not to let macro and overall market movements adjust an investment strategy. So, you have to learn the hard lessons by losing money.
of
And
course.
That's I just keep referencing that to myself. Um,
Mm-hmm.
Whenever things get panicky. So, for example, with with COVID, that was actually my best year managing money for my clients because I did not panic and I didn't sell anything. Um,
Mm-hmm.
and Similarly, did not sell anything during this most recent tariff tantrum, if you will. Look, maybe bad things are going to happen and there'll be no recovery in the future, but that's what we say every time bad things happen. Um, and I don't own the market, right? So I own
Yeah.
individual companies with specific strong balance sheets, cash flows, and ability to grow. And so
Mm-hmm.
my thinking is that those businesses should continue to outperform or can continue to outperform over a longer recovery period, even if um, the macro becomes exceptionally difficult. Now, maybe this has never really been tested and it will be different in the future. That's certainly possible. But um, selling after everything goes down because you feel scared, that definitely doesn't work.
No, it doesn't. And I can relate to what you're sharing. I own a portfolio of stocks. I don't own an index. And I feel like there's a secret advantage there because it's so easy to just sell an index if you don't feel like holding for whatever reason and maybe come back and you don't come back. And I hear those stories how people don't come back to the market for years and miss out. When you own a portfolio of stocks, as you said, you know exactly what you have in there. If you don't like one of them, then sell that. But you have the other ones and they make sense to you and you can hold on. I was buying in March of 2020 and I was buying in April of this year, 2025. And I had a list of stocks I wanted to own. They dropped significantly, some of them, and I thought it's an opportunity to buy. And in many cases, those things are short-lived. I was much more worried about COVID than the March sell-off. I thought COVID might be just a very long recovery, but I felt that I could wait for the businesses to recover. But I didn't own anything with high leverage or highly cyclical, and I knew what I own and why I own it, and allowed me to benefit from it. I want to mention one more thing that I have this belief that a lot of people find the right things, and I'm not endorsing Chipotle here, although I owned it at points in time, and I have a lot of respect for that business, and I recommend for everybody to do their own research. People might buy the right things at the right time, but the secret is holding it. And you said something that I find is very powerful, being shaken out of a position, because there will be reasons to sell. And there will be smart people telling you why you should sell, and then the whole market collapses and the whole sector collapses. There will be. When I see those charts, and I had Chris Mayer on the show, the 100 Bagger author, and the point that he makes is that there are those two situations. One, you have a stock that goes for a massive drawdown. Even the ones that are 100x over 30 years, they went down 50, 60%
Yeah.
at some point. But he says the even harder period, and I agree with it, is when the stock is dead money. Even among the Magnificent Seven, if you pull up a chart for the last 15 years, a lot of them were dead money for 5, 6, 7 years. To hold on to a stock, especially if you're managing other people's money,
Very hard.
and have them ask you again and again, are you sure we should be holding this? It hasn't moved in 5 years. And if somebody's managing other people's money, they know what I'm talking about. You will get that question. To hold on to it, I think it's really hard. Even if down the road you say, oh, it was a 10x, 20x, 50x. There are periods when it's just really, really hard to hold on to it. That's the point I wanted to make. John, I want to ask you about the luxury and the mass market segments of your universe. They're different. How are they different? How do you look at that?
So if you're talking about um, luxury like LVMH and Kering, I don't follow those areas too closely.
But even upmarket a little bit, like Lululemon,
Okay.
which happens to be, and I no endorsement of any kind, just as
Sure.
a positioning, right? There are quite a few brands that are a little bit higher. They're definitely not the
Yeah.
cheapest, right? And there are moments where I feel like they have a different way dynamic than the mass market
Yes. Okay. So if
category.
you wanted to talk about like a restoration hardware,
Sure.
which I don't
Yeah.
follow or closely, or Lululemon, which is a company that's in my coverage universe. that caters to a higher income consumer. Now, there's also an aspirational element for both of those businesses where you might have um, more middle income consumers or upper middle income consumers buying the product on a sporadic basis. Um, so generally, I think those businesses are, you know, they should do well when times are good. They're a little bit more cyclical, actually. As you go further up, if you go up to LVMH or Hermes or something like that, they have a different dynamic as well. And they tend to be more geared to international travel of very specific customer group in certain countries. Um, but the mass, I mean, there's every level in between. So I mean, if we looked at like Target, Walmart, um, generally people prefer to shop at Target, but Walmart generally has better prices. So when the
Hmm.
customer is feeling um, stressed, they will choose the Walmart shopping experience, which they might prefer less because they prefer to save money. And then when they feel a
Right.
little better, they trade back up to Target. Target also has a assortment, which is more discretionary. So apparel and housewares and these kinds of things that you can put off purchasing if your uh, finances are tight. As we look at some of these others, it becomes more, is the company creating a product that the consumer perceives to have a value relative to other things they could spend their money on? Is
Hmm.
there a trend towards whatever that company is offering? Um, and these are tough businesses. You're competing with others in the same category and other things altogether.
It's fascinating how they respond differently depending on the consumer they target. I have to ask you before we go about e-commerce and how online shopping, has changed the industry. Obviously, we still have to get coffee and a meal unless it's delivered to us at a location. But there's a lot of shopping happening online, and it's changing the whole retail industry. I do notice how many times I'm in a store and they don't have my size and they promise to ship it to me, so I can see how they're managing their inventory and they're kind of becoming an online business at the same time. But I do get to go to the store, touch the fabric, even try,
Yeah.
and then they send it to my home. How do you think about it? How does the future hold? We're gonna drink coffee at a location. We order it with a mobile app, but a lot of the sales will continue to move online.
So everything's going to become more and more integrated, and that
Yeah.
includes the inventory, as you just pointed out, but also the customer interaction with the store. And it is a little bit category specific, but even categories that have been slow, like grocery, have moved more digital, or
Yeah.
omni, which are the terms that we typically use in the industry. Um, but the first wave of companies that didn't evolve to incorporate digital or omni into their operating strategy, the first wave of those companies disappearing that's well over at this point.
Yeah.
So subsequently, we've seen mass retailers again like Walmart and Target figure out how to utilize their store bases as an advantage. And it took a
Mm-hmm.
long time for this because the store bases were not optimized to deliver to the consumer.
Mm-hmm.
And I was sitting in with the Walmart CFO in Bentonville, and he gave the story of, hey, I can order a Domino's pizza from, and it can come here in 25 minutes, custom made exactly the way that I order it, and they can deliver it right to me. If you look out that window, you can see my store. I can't get my store to deliver in 25 minutes something off of the shelf. This was maybe like 10, 12 years ago. But that's what he was moving towards. Like because we haven't optimized our distribution infrastructure to do what Domino's is doing, for example. So
Right.
they had to layer this on, which took
Hmm.
a long period of time. But in the end, that's what's created a bulwark against Amazon because you have all these stores that are already in customer neighborhoods. So once you utilize those stores to do things like buy online, pick up in store, or drive through, you now have a piece. Now, in addition to that, there's also something that these companies, larger retailers, are doing called marketplace, where they use a 3P um, partnership where they hold the inventory for small producers to ship out of their own warehouses to the customer using their e-commerce platforms. And so in that way, they become like Amazon with an extended um, product assortment and the ability to fulfill all kinds of different product with speed. So that's a very important component. It has to be fast. So because
Right.
the consumer will look for who can get to them same day or next day or whenever that they might need it. So I think it's just going to become more and more integrated. You're going to have more of these capabilities on your phone. You're going to get things delivered to you wherever you are. You're going to be able to do price comparisons. And companies are going to use a lot of loyalty mechanisms to try to
Hmm.
lock you in. So Prime is a great example. You pay the Prime membership, and then you don't bother checking the prices anywhere else because you're already getting it delivered free. So there's Walmart Plus, you've got Target Circle, and then now you have all these independent third-party delivery services like Instacart and DoorDash, which are becoming more and more integrated and delivering from more and more retail concepts to the consumer to create convenience. So it's a battle for convenience, low price, assortment, taking place not just within the stores, but also in this omni-channel digital arena.
I think the big picture takeaway is that it's something, it's a challenge that those businesses have been working with for 2 decades or more, and they figured it out. The ones that were supposed to be gone are gone, and the ones that survived found a way to optimize it and use it to their advantage. John, I have one last big question for you. Many decades of career on Wall Street, starting your own business, 3 different practices that you have right now. How do you think about success? And I'm not just talking about business. You can take it in whichever direction you want.
Um, Great question. I mean, success is being able to provide for your family. I mean, first off, and feeling financially comfortable um, and enjoying what you're doing for for a
Mm-hmm.
living. So if you actually here's one way I like to define it. So I used to say that um, I would be an investor even if no one paid me to do it. So if you can have a job where you can
Yeah.
earn a living doing something that you would do without any remuneration,
Mm-hmm.
that's like the ideal thing to achieve. Very hard. Now, there's still administrative stuff and whatnot that you have to do, which is no fun. You still have to pay taxes. You can't avoid these things. But if your actual activity is something that brings you pleasure and you can earn a living while doing it, that's a great success. And so, I think I don't want to say I'm chasing that. I feel successful. Um, I also take Charlie Munger's admonition here, which is that most people should be satisfied with a mediocre level of success because that's all they're likely to achieve, and not try to compare myself to, all the billionaires out there. Um, I don't need to have the biggest house in the Hamptons or whatnot. So, that's how I'd answer your question. And, being healthy and having a good relationship with your family, I think is very important and irreplaceable.
No, I love the sound of it, the people in your life, but also finding something you would do, even if you were if you had all the money in the world, I sometimes say how even if I had all the money in the world, I would still look at companies. I'm just intrigued how they work, how they figured it out. How come in such a competitive world they figured out a way to have a profit year after year after year and then grow it? And what is it that they do that's different, and how they're making our lives better? And as if I can become a shareholder, that's even better, and own a few shares of businesses that are doing something useful. So even if I had all the money in the world, I think you would find me sitting somewhere with an annual report reading. So I can completely relate to what you shared. John, this was such a wonderful conversation. I'm looking forward to the book. I got a flavor of it with the chapters you shared with me. Is there a timeline for it? I don't want to put you on the spot, but is there a deadline, timeline?
There's no deadline. I think I'm about 90% through the first draft. I'm really having a lot of fun working on it. So I would say, if a year from now there's a book deal, then I'd be very pleased.
Fingers crossed. I'm looking forward to reading the final version and sharing with this audience the book when it comes out and talking more about it. John, thank you so much for today. It was such a joy to have you.
Thanks very much for having me. It's been a real pleasure.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil and Baranowski.